Okay, so today is kind of your midpoint in the module. So it's your third lecture. Um, I think your TMA is due in about 2 weeks' time, more or less. So today's contents will be covered in your TMA. And so for those who have started, that's good. Those who haven't started, maybe you can start doing the questions that are covered in lecture 1 and 2. So it's fresh. All right. So today we are going to cover various topics about general ideas of like returns, diversification, and stocks. As a quick recap, because it has been, I guess, 2 weeks since the last lecture. The last lecture or the first lecture, we covered things like ratio, if you recall. So we did ratio, we did talk about like the financial statement. Now the second lecture was really focused on this concept of time value of money, right? And the idea of time value of money is extremely important in finance, particularly because whenever you shift money, right, or cash flows, like as we like to call it in finance, cash flows from one period to another period, we always have to consider the interest or the compounding effect, right? So for any cash flows, we have to consider the compounding effect or discounting effect, depending on the present value or future value, whenever we shift cash flow from one period to the other, right? So that's the basic idea. So um, remind yourself whenever you do questions, it might be tempting to say, oh, if the person have $100 every month, right, for 1 year, you just take, and what's the total? The total is very intuitive to say, okay, the total is 12 times $100, right? I mean, that's quite intuitive, but in finance, we cannot do that. Remember, we have to use the future value function to consider the compounding of the $100 every day, not every day, or every month, up to December, which is month 12. Now, let's jump straight into today's lecture. So having understand the idea of time value of money, we'll continue using the concept for the next few lectures, this lecture as well. Maybe not so much, but the next lecture for sure we'll be using it. Okay, so this lecture, let's think about two things, right? Whenever we think about returns, we should always think about risk as well, right? So in a sense, okay, maybe you are in the market to buy some stocks, right? Stocks have high returns. Some of you might already be working. You might do some investment in stocks. You buy the S&P 500. So that's returns, right? So what we must understand is that in finance, whenever we think about returns, we should also think about risk. What does this mean? It means that when there's higher returns, likelihood, there'll be higher risk, right? So the idea behind it is that there's a reward for bearing risk. So if you bear more risk, you get more returns or rewards in that sense, right? So if you see an investment with maybe very low returns, likelihood that it is very low risk. Okay, so in terms of returns, we have various ways to formulate it, but the most basic way to calculate returns is that we consider both the dividends that you get and the capital gain that you get. So the two components of returns, right? So dividends, and then we have your capital gains. Now, dividends is basically whatever that's distributed to you. It can be semi-annual, it might be an annual distribution. Capital gains is more of the increase in price, right? So a good example is, let's say you buy a stock. Of course, it need not be a stock, but the easiest to understand is the stock. So your stock gives you dividends every semi-annual, most of the time. And then your stock price increase, that's your capital gains. And so your total return is your capital gains plus your dividend gain. Right? So we have a formula here, which might be easier to understand. So first of all, it's your capital yield. So your capital yield is your dividends that you get in the next year. That's why it's T plus 1 divided by the price. T, right? So the price now. Okay, so this is the dividend yield. Your capital gain yield, on the other hand, is what is the change in price, right? So what is the price at T? Then what happens to the price after that, right? So for example, if it decrease or increase, and you divide by the price, the original price, right? So your total returns is just a combination of both of it, the dividend yield and the capital gain yield, which is given here. And these are in percentages as well, because you are taking it divide by the P at time T. That's why it's a percentage. This is just a combination of both formulas. Okay. We have an example here. So you invest in a stock with a share price of 25. After 1 year, the share price or stock price has increased to 35. Okay, so we can see that this is likely a capital gain. At the same time, they also paid dividends of $2. So this is a dividend yield. So in terms of dividends, we take 2 divided by, remember, the original price, T, price at time T, which is 25. So you get 8% yield for dividends. Now, on the capital side, we see that there's a $10 increase, right? 25 to 35. We also take it, we divide by the original price, which is price at time T. So it's 40%. The total is just a combination of 8 plus 4, 40 plus 8 equals 48%. Or you can just say that it is 12 divided by the original price, 25. Okay. So these are kind of like some basic understanding of what's returns, how you calculate them, which will help you as we progress in today's lecture. Okay. So this is an example of what's happening. So there's a lot of graph you don't really need to understand, but the idea is that if you notice what's happening, can you see small stocks, small company stocks and large company stocks? Can you see, because small company stocks, meaning companies that are relatively smaller, generally have higher risk, right, compared to big companies. So big companies, you can think of it like Amazon, you can think of it like Apple, so those are big companies, right? Small companies can be things like a small, maybe SME that is also listed. So as we see here, the fluctuation of small company stocks is higher, right? You get more returns, right? Because, for example, at this time here, small company stocks is getting more than large company stocks. So it's good. But the idea is that in a small company stock, you're actually taking on higher risk, which is why we have higher returns here, as given by the higher point compared to large company stocks, you're taking lesser risk. Okay. We have a few more just diagrams. I will not go through this just for illustration, but what I want to point at is this. Okay, this is basically a summary of what the diagrams that we have skipped. So we can see that small company stocks pay the most, as what we talked about, meaning higher risk, of course, higher return as well. In general, bonds, right? Bonds are giving lesser returns, right? Meaning lower risk compared to stocks. Does everyone know what's a bond here? Or would you like me to explain what's a bond? Okay. Yes. All right. I think we explained it in lecture 2, but let's do a recap. Okay. What's a bond? Okay. So a bond, so everyone knows a stock, right? Stock is you buy a share in a company. Okay. That's a stock. Now, what's a bond? A bond is, just think of it as a paper, right? A piece of paper where you pass this paper, you basically have an agreement between you and a company. So what do you do? So you give the company, let's say $100. The company gives you a piece of paper, to say that, okay, you have loaned me $100. And this piece of paper is basically called a bond, right? That's how a bond is formed. And the idea of it is that at the end of the period that you lend the company the $100, let's say 2 years, after 2 years, you return this piece of paper and you get back your $100. Of course, you will get some interest, right? Because you cannot be, you lend money to a company, the company doesn't give you interest. So the interest will come in the form of a coupon. Correct, coupon. What does a coupon? So coupon is like a dividends, right? So that means it's given to you maybe every semi-annual or maybe every annual, right? So a coupon is like a dividends to you. That's the relationship. And of course, the bond, the piece of paper that you hold might also increase in price. So that you can get some capital gains as well based on the bonds that you're holding. So it's very similar to stock, but it's like a piece of paper instead of buying a share in the company. Now, generally, bonds are considered less risky compared to stocks. Why? Because bonds are considered debt instrument, debt. So in a liquidation, generally debt holders would get their payment of the share first, or payment of the share of the debt first, right? So that will usually get their repayment first before your shareholders. So that's why bonds are generally considered less risky. Less risky meaning less returns, as you can see here. Now, in terms of what's this treasury bill? So treasury bill is basically the same as a bond. However, a treasury bill is a bond a bond that is issued, or this piece of paper that's issued by the central bank or the government of a country, right? So in this case, the US treasury bill, that means the bonds are issued by the US Treasury Department. Generally, for any government related, or not government related, but government treasury bonds, if you notice here, they actually peg against inflation. So what does peg against inflation mean? Meaning that the bond would follow the inflation rate. So if the inflation rate increase, the treasury bill that's being issued will have a higher return as well, right? If inflation increase, meaning the inflation average return increase, your treasury bill will also increase as well. So treasury bill and inflation are generally packed together in our market. Any questions regarding this so far? And of course, treasury bill is the lowest risk, so that's why you see it have lowest return. Okay. So in terms of return, we can use the simple arithmetic average, meaning you just take all the returns divided by number of period, right? So total returns, maybe you have a lot, 1, 2, 3, 4, 5, maybe 10 returns. Just add them all up together and divide by 10. So this is a simple way to do it. Usually we'll never use this in finance. You'll see why. So this one, I'll just move on. We'll talk about geometric in a bit, right? So in terms of risk premium, now risk premium we have we segregated in two parts, right? First is your risk-free rate. So your risk-free rate is your rate of, let's say, the treasury, right? T-bill. So let's now remember to talk about the treasury. So the treasury bill basically has no risk, or at least very low risk, like 99%, or maybe 1%, sorry, 1% risk, right? So very low risk. Generally, it's the T-bill, and this is called the risk-free rate, meaning it is almost unlikely, I would say 99% unlikely that the company, or not company, sorry, the government would default, right? When you say the government default, mean the government go bankrupt and they cannot pay you the money that you they owe you because they have issued this piece of paper called a T-bill or a bond to you, right? So generally, treasury bills are considered risk-free. So in case you need to find, in your assignment or even an exam, you need to find the value of a risk-free, and they tell you, oh, treasury bill is giving a return of 5%. So if they say that, you must immediately know that this 5% is a risk-free rate. All right, I repeat again. So this is important, is in case you encounter any questions saying that the treasury bill is 5%, we give it a return of 5%. You need to know that when they say this, it means the risk-free is 5%. So it's 5%. Risk-free rate is 5%. Right? Treasury bill equals to risk-free. So any returns that's above the treasury bill rate of, let's say in this example, 5%, anything above, so for example, your stocks, let's say stock A, right? We don't need to give a name. Let's say stock A is giving 8% return. So what is the risk premium? So the risk premium is anything that's in excess of the risk-free rate, right? Excess of risk rate. So your risk premium here, anyone can tell me what's your risk premium in this example? 3%. That's right. So it's 8 minus 3. Thank you. Sorry, 8 minus 5. So it's 3%. Perfect. Thank you. So your 3% is your risk premium. That's right. And this is your reward of bearing risk, right? So remember, because you take on more risk, that's why you get a 3% additional 3% return, right? Remember when we buy let's say when we buy this thing called stock A, your stock A can actually go into default because you're buying in a company, right? So that's why there's a bit of like risk. Maybe the company default, maybe the company go bankrupt. That's why you get more return, right? So where you have higher rate of return means that you're taking on more risk. In this case, you're taking on maybe the risk that company A would go bankrupt, unlike the treasury bills that's issued by government, which is almost 99% sure that you'll never go bankrupt, right? The government will never go bankrupt. Okay, so with the understanding of T-bill, that T-bill is the risk-free, we can calculate the risk premium here. So these are all the T-bill rates, right? So these are all the risk premium that you pay. And of course, you notice that for treasury bill, you pay zero risk premium because it is risk-free. All right. So we have been talking about this thing called risk quite a bit. Now, let's try to understand the idea of risk. As usual, I like to try to give you a big broad picture before we go into the calculations and details, right? So the idea about risk, and we have talked about risk quite like since the start of the lecture, is that what is the variation of your returns over time? So what does this mean? It means that if your returns vary a lot, meaning that okay, you can get a lot of money, let's say 100% returns, or let's say you buy, let's say, one stock, and this stock can increase from $10 to $100, but the next day it can drop to negative $90, right? So if there is a lot of variation, means that your stock that you bought is very risky, right? So the idea of risk is simply the fluctuation in your returns, right? And because to have this idea in the back of mind is important. Why? Because as we progress along, we'll see calculations of how we can calculate risk, and then we'll start breaking down risk into many other components as well, right? But on the baseline, the fundamental understanding is that risk is simply the variation in the returns, right? How varied it is. And generally, as we plot the variation across time, the variation of any financial product across time, we notice a normal distribution here, right? As we can see in this graph. Okay, so because of this normal distribution, we can actually calculate risk and we can calculate risk using this thing called variance um, here, which measures the dispersion across the normal distribution that we have saw earlier. Now, I have a question. So, is there a reason why we do not just use variation var in risk? Instead, we use this thing called standard deviation, right? Where we square root the var and then we get this thing. And this is actually called volatility, and it's the measure of total risk. But the question is, why do we not just use variance? Why do we need to use standard deviation here? So does anyone know why do we not use variance as the measure of risk? More precise? But both are the same, no? Because standard deviation is just a square root of the variance. Clarity of data, okay. Not really. Anyone wants to give one more try? Okay, maybe not so sure. All right. So we know that the standard deviation is the measure of total risk, right? So whenever we say what is the total risk, we use standard deviation. And standard deviation is just the square root of the variance. And variance basically measures the dispersion of the returns, right? If it goes, there's sometimes very high, sometimes very low, it measures risk. Yeah, the standard deviation, the deviation from desired data, and usually the desired data is the mean, right? The mean, so this is usually the mean. Mean is X bar, right? The mean is here. And what's the dispersion? This is a dispersion, right? And usually this is measured in standard deviation like this. Sigma, right? This is the thing. So to answer that question, why do we not use variance instead? Is because of this thing, actually, that the answer is just here. Same unit as average. So what does this mean? It means that you notice for a variance, your units is percentage square, right? If you're talking about stock returns, right? Returns are always measured in percentages. So in the variance form, is percentage square. However, once we do a square root of this, which gives you your SD, right? The units becomes percentage. And it is easier to compare percentages with the average, the mean, or even between companies, right? Compared to what is 1% square, is 1% square bigger than 2% square? Like what does percentage square mean? It's very, very hard to understand, right? That's why we use standard deviation, where we square root the variance to give you the same units of percentages. So to conclude, what's important here is we need to know that total risk is measured by standard deviation and not variance, even though standard deviation is derived from variance, right? So total risk. So I'll put a star here. This is important to know total risk because, as I mentioned earlier, we are going to dissect the risk as we go along, right? Dissect meaning we are going to split the risk and then we have different kind of risk. But if we want to talk about total risk, it is standard deviation. Okay. So maybe this is a bit of like a recap of your secondary school. To calculate standard deviation. Maybe if you recall your statistics in secondary school, this is what we are repeating again. So how we calculate variance is the idea. Okay, let's talk about idea before we look at the formula. Idea is that what is the variation from the center, right? Or what's the desired data? And the center in a normal distribution is the mean. So what's the deviation from the mean, right? So how do we understand this formula? So this is the return of a stock minus the mean return, right? So it shows you what's the deviation from the mean, right? That's why we take the return minus the mean. Then we square it, and then of course we do a summation, meaning that we are going to add all of this value here. We just plus everything, and then we divide by t minus 1. Okay, I have a question here. Why do we take t minus 1 and not t? Anyone knows? That's right. Okay. Yes, because you do not have the population. You're right. You're right. So in this case, you are calculating the sample sample variance. So, in case if you are using Excel, of course, you will never use this formula because Excel can help you do it and you can have access to Excel even your exams. So remember to use the variance.s formula, right? Meaning it's sample. Because you do not have the population data. Now, it's correct because the reason why is because you're using sample compared population. However, the um the backstory behind it, why uh, a sample standard deviation formula is different from population variance formula is because this minus 1 is basically this thing called, so this is just for you to understand, you don't need to if you don't understand, it's fine. Is called the degree of freedom, right? Degree of freedom. So what's happening here? So this is, I repeat again, you do not need, if you don't understand, it's fine, but it's just good for understanding in case somebody ever asks you. Maybe if you are taking statistics or your math professor asks you this. So the degree of freedom, the idea is what? Imagine you have a few numbers, right? Let's say you have 3 plus 4 plus 5 plus 10, let's say. Then equals to, let's say, 15, 19, 20, 22, right? Here we have 22 here. Okay. So imagine we have 22. Now, if the degree of freedom, the idea behind it is that given we have this number, 22, we only require 3 other numbers, right? We do not require this number because we can derive the number 10 if we already know this number and these 3 numbers here, right? So in similar sense, you kind of lose 1 degree of freedom because this 10 is gone. You don't need it anymore, right? So in this sense, we need to minus 1 here. That's why you lose 1 degree of freedom because here you already have the mean, right? The mean is like your 22. So the number of data that you require is actually only 3 data here instead of this one, instead of 4. That's why we have a minus 1. So maybe a follow-up question would be, there's actually a minus 2, can be minus 2 degree of freedom, minus 3 degree of freedom, that's possible as well. And there are various reasons why, right? Generally, is as the population gets, or the sample gets smaller and smaller, you must take away more degree of freedom, right? But that's out of our topic of finance, it's more statistics. Okay. So having understand this small little minus 1, we know that the standard deviation, we just square root of the variance here. And we have an example to show you. Okay, so we are given these 2 things, right? We number the years and we are given the returns as given here. I want you to take note of this this is important, I put a star here, that these are returns. Okay, returns meaning they are in percentages. Remember how to calculate returns? Everyone recall when we first talked about it earlier? How do you calculate returns? It's not okay. Not really. We have formula, remember? How we calculate returns? We take the capital gain plus the dividends divide by initial stock price. Recall? The first thing we talk about, remember? I say that will be a basis of why we will continue the conversation in the lecture, right? So returns is the dividend gain plus the capital gain divided by stock price at time t, right? So why do I put this as a star? Is because this is not stock price. So in case a question gives you a list of stock price, that is not the number you want. You need to calculate returns first, use the returns to thereafter calculate your variance, your historical variance or variance. Okay, I'll repeat again. If a question gives you stock price, you need to do one more step. You need to calculate returns before calculating the variance or standard deviation. Okay, and how to calculate returns, we talked about earlier, the first topic, right? The first discussion we had, which is capital gains plus dividend divided by initial stock price. Okay, so we do a sum of all the returns, we calculate what's the average, and this is basically just the arithmetic average, right? So we just take 57.41 divided by 5, right, to get the average. As per the formula, I'm just going to flip it back. As per the formula, we need to take the stock price minus the average and you square it, right? So we are going to do the same here. We're going to take the stock price minus the average, and then which is here, and then we square it here. So we do it for all the returns, here, 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 and then we sum it up together, and this is your, and then before that, after summing it, remember we need to divide by t minus 1, meaning we divide by 4, right? So divide by 4, we get the variance, the standard deviation, we just square the variance. Any questions so far regarding this statistical kind of like variance calculation? Okay, I guess no. So when calculating variance, we see that by doing so, we are able to describe the risk profile. Remember, standard deviations equals total risk. So the total risk of a small cap company is very high, as we notice a large standard deviation, right? What standard deviation is the deviation from the mean. Can you see the deviation is a lot? Now, compared to government bonds, can you see the deviation is so small here, right? Small deviation. So in terms of total risk, the small company stocks are much riskier compared to the large company stocks. This is just a repeat of what we talked about, being a or the description that we had, being a normal distribution. Here's the mean, and this is the standard deviation from the mean. Now, in terms of arithmetic and geometric mean, So the arithmetic mean is what we have, is what we have talked about, where you just take the sum, right? The sum divided by n, right? N meaning the number of returns in this case, right? So the idea of a arithmetic mean is the return in an average year over a period of time. So this is average year. Now, when we think about geometric mean, we consider the compounding of the returns, right? Over a period of time. And we'll have a look at how we calculate that in a bit. So just in case you are, not sure what geometric mean is, we'll have a look at the formula. And what does it mean? It means what is your average compounded return per year. So the idea is per year here. And we'll see what it means in a bit. So just hold a thought if you are not sure what does this mean. So in general, geometric mean will be less than arithmetic mean. Okay. And we'll have a calculation to prove that. So the geometric mean, or AGR, this is the formula: 1 plus return times 1 plus return 2 times blah blah blah. Then you square you take to a power of 1 divided by the number of period minus 1, right? So this is how you calculate geometric mean. This is just another way to present it. This is called the product sum. So it's just a bit more fancy, but it's the same. Now, this is the example I usually like to use here. Okay, so recall that just two slides ago, I talked about the difference between geometric and arithmetic mean, right? So what's arithmetic mean? So first we are given stock price. However, we cannot use stock price. Recall, we need to use the returns. So what is the return from year 1 to year 2? Year 1 to year 2, the return is 100%. How we get 100% here? $1, because there's an increase in $1, right? Divided by the initial price of $1. So it's 100% returns. Now, for year 2 to year 3, so there's a decrease, right? So minus $1. Now, what's the initial price? $2, right? So we get negative 50. So negative 50 is the returns from year 2 to year 3. Now, this is the important part, right? So for the arithmetic return, we just add these two. So for arithmetic, we just add these two, divide by 2, and that's how we get 25. In your geometric, we have, remember the formula, 1 plus return, right? So 1 plus 100% times 1 plus negative 50% to the power of, because there's 2 returns, so to the power of 1 divided by 2 minus 1. And we get answer of 0. Now, going back to the properties of arithmetic versus geometric, as we see here, we say geometric is always less than arithmetic. Okay. This is true, right? As you see here, see, your geometric is less than arithmetic. Now, to you, which return makes more sense? Arithmetic or geometric, and why? Okay, thank you. It's compounded. Correct. Okay, the answer is correct. Yeah, geometric. And you're thinking about compounding, which is correct, because in finance, we always think about compounding. Yeah, that's true. That's true. Thank you. That's right. Now, if you are a investor, I like the idea of principle of investing. Or if you're an investor, let's look at this return here. Year 1, you have $1. Year 2, you have $2. Year 3, you have $1. Okay, so year 1 is where you put the money in, right? Imagine you hold until year 3. You take the money out. Now, to you, as an investor, do you make any returns? You put in the money at $1? Yeah, no, right? You put in money $1 at year 1, I take out at $1 at year 3. And can you see that geometric return give you accurate, which is why I like the answer, right? That your friends have mentioned. It gives you a very accurate example of returns because yeah, you actually have zero. But can you see arithmetic say you have 25%, but in reality, you do not have 25%, right? So the reason why is goes back to the definition of yeah, yeah, correct. Inflation wipe out your gain because you have zero, and then inflation you minus something, right? So it goes back to the a comment that I mentioned about what is arithmetic, what is geometric, right? Because in arithmetic, they are using the I'm going here average year compared to return per year on compounded basis. Okay, so that is the reason of average and so what compounded return per year basis. So in finance, we never ever use arithmetic because immediately you can see it doesn't make sense, right? How can you have 25% return when obviously you have zero since you put your money $1 and take out at $1? So we always use geometric. Okay. So this is an example of geometric returns. This is the return. You have 1 plus the return, and then you compound it, right? Compound it meaning you just take so for the first one it's just this. So for the second one, you do this the same thing, but then for this, remember we take 1 plus R times 1 plus R again, right? This is everything's ugly. Let me rewrite this again for you. 1 plus R1, 1 plus R2, like this. And then we formulate the returns and we to the power of 1 divided by 5 because we have 5 periods, and then we get the geometric returns. Um, okay, I see a question here. So a friend of yours asked a question: if the increase in this example here, let me just erase this. It's a bit messy, so everyone can have a look. So what if your increase is $1, but instead of $2, it becomes $1.5, and then it becomes $1, right? So in this sense, we can do a calculation, but then maybe your geometric will be equals to your arithmetic. And this is just by coincidence, right? That it becomes equal, and then maybe both methods are fine. Of course, we know that this example of $1 becomes 150 becomes $1 is very simple because you know stock price is never so nice. $1 is like 1 point something something something, and even when it's go up to 150, it'd be 1.5234 something like that. And because of this, it is very unlikely that your arithmetic will be equals to geometric. And the only case when they become equal, as what we mentioned earlier, is when unless all returns are equal, right? So then the arithmetic might be equals to geometric, or your geometric might be more than arithmetic, right? But these are by coincidence. Okay, since geometric we are using compounding, right? We're using compounding, so we can actually use the time value of money formula. I hope you do remember. If we are given what is the final value here, right? So if let's say a question, so this is how usually they like to twist the questions in your assessment, right? So for example, they say, oh, we have a stock, okay, that is calculated using geometric returns, and the final value of your stock is 1.4870 here. Okay. Your initial price of the stock is $1. So your initial price is $1. At the end of 5 years, your stock price has increased to this. Now, the question is, what is your geometric return? So the question do not give you any of these. They just give you this information, and say it's 5 years. So in this sense, we need to immediately try to understand that because geometric return is based on compounding, we can actually use the time value of money formula, right? So n equals to 5. PV is 1 because your initial price is 1. Your final value is given by this 1.4870. There's no payment here because you have nothing that's being paid. And so we get a interest, or not really interest, but in this sense, geometric return of 8.26. So this is an alternative method to calculate geometric return by deriving or by utilizing the idea that is time value of money, and is using the geometric compounding. So the question is, which is better? Arithmetic is overly optimistic. Geometric is overly pessimistic. So it depends on time horizon, right? So these are some guidelines. If your time horizon of your investment is 5 to 20 years, you use arithmetic. 20, 40 years, you split. And 40 and above, you just use purely geometric. Now, these are very rough guidelines, but to be honest, in practice, so this is in theory, right? Theory, this is how we segregate geometric and arithmetic. However, in practice, we only use geometric. We don't use arithmetic at all if we want to calculate a mean. And the reason because of what we saw earlier, the arithmetic doesn't make sense because we're taking average year. But we are supposed to focus more on the compounded return per year basis, right? That's what we mentioned. So in practice, we always use geometric. However, in theory, for understanding, this is the guideline. Okay, so before we move on to efficient market hypothesis, I would like to just pause here. Any questions so far regarding what we have covered? So the first part is really more like statistics, right? So now the next part, we are going to talk really more finance really. So we talk about some kind of theories. Okay, so we are all good for the statistics part of things. Okay, so I guess there's no questions. That's good. So now moving on to the efficient market hypothesis. So now let's put aside what we have understand about geometric and arithmetic mean, about statistics, standard deviation for a while, because we're going to talk about it again later. But let's put that aside first now. Now, let's think about finance, back to finance and theories again. So we have this thing called an efficient market hypothesis. Sounds scary, but don't worry, it's not. So before we go into the details of what all this whole hypothesis mean, right? Let's just think about it. Again, the broad concept of it. The broad concept of this efficient market hypothesis is actually just trying to say that there are various types of information in the market that is going into the market, and is trying to connect the types of information to how the market respond to the type of information, right? And when I say type of information, it could be public information, private information, secret information. So how does the market understand the new information that is provided to the market, right? We talk about market as if it's like a person, right? So like, oh, how do you try to understand the information, right? So that's the broad idea. So you have a lot of information. How does the market try to process and understand information? And this idea of different types of information and different processing of the information, the way it's being processed, brings about this thing called the efficient market hypothesis. Okay, so what does this mean? It means, now let's go into detail now. So the details is that it means that the stock price on average is in equilibrium, they are fairly priced, and information is efficient. So this means that whenever there's information provided to the market will use the information and immediately price the information in. Price information means that if there's good information, the price will go up. If it's bad information, it will go down, right? Immediately it will do that. So that's what the hypothesis says. Now, if it's true, if these three conditions hold, means that you should not earn abnormal, I want to put 2 stars, abnormal returns or excess returns or alpha returns. So they're all they means the same thing. Normal return, excess return, alpha return, they all means the same thing. But it means that you will not get this kind of returns, right? So it's impossible to beat the market. Now, the important, I'm going to put 3 stars here. The important thing is that it does not mean the market or the investor cannot earn positive return. It does not mean that. It means the investor can earn positive returns. However, you can only earn market returns, right? So what is market return? So imagine market returns as like your S&P 500 returns, right? S&P 500 is like just a broad kind of market returns, not like some very um, super high, like 40% return. Maybe S&P nowadays is like trading 5 to 8% return. You just get 5 to 8% return, and that's the best you can get, right? So if you believe in this efficient market hypothesis, you are saying to the investor or to yourself that okay, you can earn returns, but you can only earn market returns, which is equal to like S&P 500 return, but not abnormal returns. Abnormal means you cannot earn like 40%, 30% returns, right? Or these are called abnormal returns or excess returns or alpha returns. So different words. So it means that you're impossible to beat the market. Everyone understand this is an important concept. So everyone understand that the meaning of what efficient market means. Okay. So whenever we get information, an efficient market reaction would be the information straight away goes up, right? The stock price. So if it's a positive information, the stock price straight away goes up and then goes straight like this, right? So this is an efficient market. However, we know that this never happens, right? Either the price goes up like this, so goes up like this, meaning a delayed reaction, or sometimes there's an overreaction, goes up and then goes down like this, right? So this is for positive information. And because we notice that the market does not follow the efficient reaction, meaning just go up and straight like that, just go up and straight, and there's usually some delayed or overreaction that's happening. Because of this, we know that the market is not efficient. And because we know the market is not efficient, we have 3 different forms of efficiency that based on the efficient market hypothesis, we derive these 3 forms. Okay, so there's quite a bit of information here. Do not worry, this is more like a summary slide. I'll go into details in the next slide. So there's a strong form, semi-strong form, and weak form. Okay, so let's go into details first, right? So what's the strong form? So a strong form efficiency, is part of the efficient market hypothesis, right? Is where the price reflects all information. So this is important. Oops, this is happening again. It reflects all information. Oops. Okay. Okay, so it reflects all information in the market, including public and private. So this is important. Include public, private, all the information it includes inside the market, in the market reaction. So if it's true, it means that the investor cannot earn abnormal returns. Remember, abnormal is like excess returns or alpha returns. We have different names for it, regardless of the information they have, right? Because even they include private information in the market. So this is an efficient market approach. And the idea is that if you believe that the market is strong form, you just hold a diversified portfolio. And that's all. You just hold a big portfolio because at the end of the day, you just get market returns. There's no point trying to beat the market because you cannot, right? The market has included all public and private information. So empirical evidence indicates that the market is not strong form, right? Not meaning what? Meaning that if you have some kind of illegal insider information or private information, you actually can earn some abnormal returns. Now, the strong form has all the information inside, right? Now, if we just think about the weaker form, which is called the semi-strong form, meaning it's slightly weaker, means that the market only reflects public information. So private information is not inside it's not priced into the market, right? So it's only publicly available information. This includes, trading information, annual reports, press release. And if this is true, the investor cannot earn abnormal returns based on public information, right? So if the investor have some secret information, private information, insider information, he or she can actually earn abnormal returns. But if you only have public information, you cannot earn abnormal returns here. And the idea of fundamental analysis. So fundamental analysis is like your ratio analysis. Remember your ratio analysis that we talked about in lecture 1. So if you do ratio analysis, remember your ratios are always based on annual reports, is based on public information, right? It means that if you do fundamental analysis, you cannot earn abnormal returns because you are just doing using public information. So you cannot earn any excess return based on a semi-strong form efficiency. This is also an efficient market approach. Okay. Now, last but not least, we have the weak form efficiency. And weak form means that the price only reflects market information. So this is the important part, past market information. So what's market information? Market information means like the movement of the price or the volume of trade that's happening, right? So only market information. So if this is true, the investor cannot earn abnormal returns based on market information. So market movement, market volumes, all this. And it implies that technical analysis. So technical analysis means like, you look at the price of the stock. So this is the price of stock. Let's say it's going upwards like that. So technical analysis is usually you draw some charts, you draw some lines. For example, you say, oh, this is an upward slope. You draw this line here. And then maybe you draw a middle line. This is the average. And this is your base, something like that. You draw some lines. And this is called technical analysis, using some charts and lines to predict the market. So if you use this kind of charts and lines to predict the market, it is unlikely or it will not lead to any abnormal returns. Why? Because the market has already taken into account all your market information, right? It has already taken all the market information into account for you in the price. So you must use fundamental analysis here in this case, if it's a weak form. So empirical evidence generally says that market is a weak form. Maybe I'll pause here. This is a bit more like theoretical. Any questions, any clarifications you'd like to ask for these 3 types of market efficiency? Because this is a bit theoretical. Any questions? Any part you'd like me to repeat? Things that you're not too sure. It's important. This thing is important because most likely, usually they'll kind of try to test you in the form of like a scenario and ask you to describe and explain, is this a weak form, is this a strong form, or how and justify it, right? Oh, that's a good question. Thanks. So how do you know if investor earns abnormal return? Now, how is basically you compare it, right? So you compare what's market return? So market returns, remember, is S&P 500 returns. So if your investment portfolio earns, let's say S&P is 500, 5%, S&P 500 is giving 5% return, which is market returns. If your portfolio you created is giving you 10%, no, let's say 12%, you see that you are actually getting abnormal returns of 12% minus 5%, right? 5% of market return. So if you get around 7% abnormal returns. So that's how you calculate in a simple way. Yeah. So only the strong form and semi-strong form are efficient market approach. The weak form is inefficient. Basically, it's inefficient. Is part of the efficient market hypothesis, but is considered not efficient, right? Because it's weak form. It only includes market information. So this is just a summary of what they include. Weak form is only market information. It's just a diagram. So on this point, there's usually a lot of misconception, but I'd like to highlight to you that efficient market hypothesis does not mean you cannot make money, right? You can make money, but you only make market returns, right? S&P 500. It does means that on average, your return is appropriate for the risk undertaken, meaning that the more risk you take, the more returns. It's proportionate. There's no bias in price that can be exploited to get excess return. What does this mean? It means that you basically get S&P 500 returns on average, right? On average. Market efficiency will not protect you if you choose not to die. Okay, this is an important point, right? I'm going to put 2 stars here. What does this mean? It means that in order for you to conclude or to say anything about this thing called efficient market hypothesis, first of all, your portfolio must be diversified. So imagine if your portfolio include just 100% of, let's say, now very popular meta stocks, right? If it's 100% meta stocks, can you use this efficient market hypothesis to try explain your returns? No, you cannot. Why? Because you're only holding one kind of stock, 100% of beta stocks. So you cannot do that, right? So efficient market hypothesis does not apply to you because you are not diversified. So the efficient market hypothesis only applies to you if you are fully diversified. Okay. So there are some self-review. So this is the first part. There's some self-review questions. As I mentioned in the last lecture, I've added all the answers to self-review. So you can practice them and then you can just compare the answers if you want. If you have downloaded the old set of slides, there are no answers, but now I've included all the answers. Okay, so you have 2 questions here. Okay, that's a good question. So are there exceptions to the hypothesis? Yes, there are. And so you're right. The price can move up and down aggressively due to like unpredictable environment or even war, natural disaster. That's true. So the idea of efficient market hypothesis is on average, right? On average, meaning what? When we think about average, we are thinking about maybe 30 to 40 years type of time horizon, right? So yes, there might be some fluctuation, exceptions within 2, 3 years, 4 years, or even 5 years sometimes. However, the efficient market is based on average, you will not get any excess returns. On average, so that means like if your price go up, down like that, then it goes down again, and it goes up. So these are like in average year. So like something like this. So imagine your graph is like this. So on average, you are getting something like here. So this is your efficient market. Like this is your average, your baseline, right? But yeah, at some point you got a lot of money. Some point you lose a lot of money. But on average, you are like you can't get any excess returns. Yeah. So you have a question here. If there are multiple stocks in the same industry, it's not considered diversified. Yeah, that's right. If it's the same industry, it's not considered diversified, right? So if you think about diversified, when we say diversify, it must be diversified in different industry, different sector, healthcare, maybe consumer goods like groceries, or maybe even aviation like SIA, like between different sectors, and also diversified between different geography, right? So we have your, let's say, SIA, maybe Keppel stocks, which are Singapore based, maybe you have some US, maybe like Meta, Amazon. So you need like geographical diversification. You also need sectorial diversification, right? So different sectors. And also even diversification based on product type, right? So you have stocks, you have bonds, you have real estate. So you need a lot of diversification. And efficient market hypothesis only holds when you are fully diversified. And if you're not fully diversified, and let's say you have 100% meta stocks, and maybe next year meta stocks drop 30%, too bad for you. You're not protected, or you cannot blame efficient market that, hey, you know what, efficient market say I should not be, I should earn market returns, but how come I have negative 40% returns? Because in your case, you have 100% meta stocks, and yeah, you're not protected in this case. Okay, so I think now is a good time to take a break. As usual, I think we try to do two breaks so you can just take a rest, go to the toilet and all, maybe even get a coffee if you're very tired. So let's come back let's take maybe a 7 minutes break. So we come back at seven, no, 8:16, around 7 minutes, 8:16, 8:17, right? If you have any questions, put in a group chat. Let's take a small break. All right, welcome back from the short break. I think there's no other questions so far. Okay, so we have covered a bit of the statistics part, a bit of the efficient market hypothesis. Now, let's move on to thinking a bit deeper in into how the returns that we talk about relates to finance, right? Because just now when we discuss the standard deviation, we talk about arithmetic, geometric. These are very like more statistical kind of explanation. But let's bring it back to finance now. Okay, so let's think about this thing called expected returns. Earlier, we have discussed about geometric arithmetic returns. But actually, what are we interested in finance? In finance, we are typically interested in this thing called expected. So when we see this word expected, generally it means what is the outcome in the future, right? What is it likely to be in the future? And when we see expected, there is always this idea of probability in our calculation. And in finance, that's what we're interested in, right? Because we are interested in how the market will move tomorrow rather than what the market has moved in the past, right? So past information is not so relevant for finance. So in the idea of expected returns, um, we we have this equation. And what this 1 and 2 means, it means that we do this part first, then we do the second part, right? So we take the probability, PI, times the expected or the returns in the state I, right? PI meaning in the state, probability in state I, times the return in state I. And then we do the summation, right? So this second part, summation meaning we add all the returns together, and this is how we get the expected returns. We have an example, so don't worry. So here we have the various states: recession, neutral, and a boom stage, and the various probability, right? So these are the expected returns on each stocks, stock A, stock B. So how do we do it? We take the we take the probability multiplied by the returns, right? So in the next page, we take the probability of 0.25 times the returns here to get this. We do this times this and this times this, right? So we get all the returns, expected returns as shown here. And then we do so this is part 1, this is 1, and then we do a summation for part 2. So this is the expected returns. So how do we understand this? So the expected returns for stock A is 11.25%. The expected returns for stock A is 11.25%. Now, in the same way, we can actually calculate the expected standard deviation as well, or variance. So again, this doesn't repeat. Variance standard deviation measures volatility or total risk. So total risk is measured in standard deviation. And recall this is your standard deviation formula, right? So what is the returns? I minus expected returns. So expected returns is like your mean returns, right? The mean R bar, which means the mean, right? Multiply by the state PI, and then we do a summation as well. So we have an example, do not worry. So this is the example of how we calculate it. So we have the various states again, as we see here, the various states. These are your expected returns. So remember your formula is you take and then we have these are your returns, and then you have expected returns here. So we take the returns minus the expected return, and we square it, right? So this is the formula as shown here, right? So returns minus expected returns square. Okay. And then after that, that's step 1. Remember step 2 in that bracket thing that I put on the formula is to multiply by the probability. Okay. You do a summation of everything, and then later you square root it to find standard deviation. Okay. So what we have calculated earlier are individual stocks, right? What's the stock A expected return? What is stock A standard deviation? What is stock A variance, right? But in finance, as we have discussed already, and some of your friends also pointed out, that there's this idea of diversification. So diversification means that you want to not only have one stock, you want to have many stocks. And when you have a collection of stocks, these are called a portfolio. So whenever you have a portfolio, there is some risk and return impact on how you actually create this portfolio, right? And so there is this, of course, there is a trade-off between the risk and rewards. And so this is what we are trying to understand here. Now, first, let's try to understand the portfolio expected return. So now there's two parts. First is the expected return, which is the same part that we talked about earlier. And now there is a portfolio version of it. So in this case, the expected return for portfolio is given by the weight of each asset in the portfolio, right? W is happening again. It was given by W. And the first part is kind of the same that we look at, right? So I think I shouldn't touch it, but I'm just going to explain for the number one in this formula. It's the same, right? P times R, PI times RI, which is what we have seen earlier here, right? In the earlier slide. Now, the additional part is about multiplying W inside, WJ. So W is the weight or the percentage of each asset in the portfolio. And we have an example to show as well, right? And then after that, last but not least, do the summation. So whenever you're confused about these kind of formulas, start with 1, 2, and 3. So you go 1, 2, 3 like this. Okay. So we have an example here on calculating the portfolio expected returns. So we have various dollar amount invested in the portfolio. We calculate the weight WJ of the portfolio as given by here. Now, in this case, we are already given expected return. So meaning that we do not need to multiply the probability times the return, right? Remember what we did previously, probability times return. We don't have to do it now. They give you expected return already. So simply, we just take this times this, times this, times this, multiply by weight basically. And then after that, we do a summation, which gives you 10% here. So this is the part where they give you the PI, right? And they give you the return of its stock. So what must you do now? So now you need to calculate expected return. Remember, PI times RI, right? And then PI times RI, PI times RI, PI times RI to calculate what's the expected return, 12.5. Then we multiply by the stock, the weight of each stock. After that, then you must sum it up. We sum everything up, right? So this is the full calculation. So the difference between this one and a previous one, they give you what's expected return here. So you do not need to take the P times the RI. Now, in this case, they give you the P, they give you the RI here. So you need to do the P times RI to calculate what's the expected returns. Then after that, you multiply it by the weight of each stock. So in our lecture, fortunately, we will not have time to do the individual calculation to show you our calculations, but I highly encourage you because in the slides, you already have the so-called answers. try to just work out the calculations on your own when you review the slides to see whether you can get the answers eventually of 10, right? So it is easy, I would say, but then it's important to at least try it once. So in case, you face a question like this, you will be able to surely know like, oh, okay, I've done it before. You just need to multiply it like this, like that, and then we get an answer. Any questions for expected return for a portfolio? I'll pause here for a short while. Okay, I think expected returns a bit more, uh, how you get 0.9 variance. How you get this? This one? Okay. So you just sum it up here. You just sum it. So add all of these together. Because recall that the variance is the summation, right? The last step is summation. So after you multiply by pi, which is what we have done here, after you multiply by pi, then you just do a sum of everything. Then you get your variance. I'm just going to write here sum. Okay. Thanks for the question. Let's move on. So returns are quite direct, right? The way we calculate returns are quite direct. Now, when we think about portfolio, because now we're at the stage of portfolio, yeah, meaning multiple stocks. When we think about portfolio standard deviation or variance, this is no longer so direct. So it's a bit more complicated, right? So the idea is that the portfolio standard deviation is not the weighted average or just the average of your standard deviation. Why? Because the portfolio standard deviation usually has some diversification that I think your friend mentioned earlier. There's some diversification that's happening here. And we'll try to understand where the diversification comes from, right? So just know in your back of mind that there's some diversification. We'll do the calculation to show that there's actually some diversification happening. So returns, we already talked about it. I'll not go through this again. I usually like to skip this slide because I have an example which is even clearer. So I'll not go through this slide. Let's look at this example instead, right? So it is kind of almost the same thing as the other slide. Okay, so now we are trying to calculate the portfolio variance or portfolio standard deviation. Okay, so what do we have here in terms of information? Okay, we are given two stocks, BB and SM, and their returns and the number of years. We have 5 years here. We are given three portfolios here, A, B, and C. Okay, and the composition of each portfolio is different. So in portfolio A, we have a composition of 25% BB, 75% SM. In portfolio B, we have 50% BB and 50% SM, and etc. Right? Okay, so we understand the information now. Now, let's calculate the portfolio mean and standard deviation. Okay, so there are two methods. Method one. So method one is your statistical method. Okay, I like to call it the statistical method. So you're using statistics to calculate. Both methods are acceptable. And method two is the finance method. Okay, so understanding both methods is important because we do not know when you need to use which method. Usually questions do not force you to use one method. However, sometimes one method will be easier given the question, the information. It'll be easier to calculate. So we need to understand both methods. This is very important, I would say, this concept here, and you really need to understand how to calculate it. Okay, so let's try to understand what's happening here. So method one, statistical method. So we are being given the various returns as we see in the question. Okay. Now, how do we calculate the mean for each portfolio? We are also given a portfolio percentage, right? 25% BB, 75% SM. So going back to this page here, let's say we are taking year 2016. Let's look at 1 year first, okay? 2016. Now, to calculate portfolio A, we know that there's 25% of the first stock, right? So we know that first stock is giving negative 6.29% in 2016. So I'm not going to flip over. You have your slide. So just flip over to confirm the data if you need to. So we put 25% times this, and we know that 75% of their second stock, which is giving 8.23% in 2016, right? So these calculations here, right, basically are the ones in red. That means I just show you how to calculate, but you need to calculate for every year. So you calculate for 17, 18, 19, 20. So you need to calculate every single year. With Excel, it's very fast, so do not worry. You need to calculate for every single year, right? The portfolio returns based on the weights as shown. So I'll give an example for portfolio C here. So portfolio C, we know that for portfolio C, we have 75% of the first stock. And the first stock in 2018 is giving 22.91%. And we have 25% of the second stock, which is giving 2.71%. Okay. And so once we are able to calculate all the returns here, given like this for portfolio A for all the years, we just divide by 5. You can get the mean portfolio returns for stock for portfolio A. Okay, now that part is maybe a bit simple for everybody. Let's look at the standard deviation now. Recall that the what's the meaning of standard deviation? The meaning of standard deviation equals to total risk, but it means what is the deviation from your mean, right? Your normal distribution. What is the deviation from your mean? So having already calculated the various returns here, given by this, which is what we have done in the previous here, exactly the same. I'm just copying it over. Right? Having calculated that, we just use the Excel formula, standard deviation sample dot s, because we need to consider degree of freedom as we talked about earlier, right? So we just use this formula, and in your Excel formula, you just select this chunk, and then you get your standard deviation. Very easy, right? Because the idea is that, okay, you have various, your portfolio A has various return, and we just need to decide what is the variation from the mean. So you just use the standard deviation formula. You can do the same for here, and do the same for here. Any questions regarding method one of portfolio standard deviation? Okay, so do we need care? Yeah, in this sense, because the question did not say whether it's arithmetic or geometric mean, we take it as we need to use the arithmetic. So in this sense, right, this mean here is the arithmetic. Oops, okay, it's happening. Is the oh wow, okay, is the arithmetic mean. So something's wrong with this. Let me see again. Oops, doesn't work. Okay, so arithmetic mean in this case. Usually the question would specify to you if they want geometric. They'll say calculate the geometric mean. If not, it's arithmetic. Okay, so in this method one, statistical method, yes, we are quite good. We can calculate the values relatively easy. But the problem with the statistical method is that we do not see this idea of diversification happening. So all these answers are sorry, all these answers are perfect, right? You get 100% of the marks. However, you do not see diversification happening. So the finance method is where you are able to see the diversification. So let's look at the finance method. So method two. Okay, method two, again, we calculate the portfolio mean. And the way you calculate portfolio mean in method two is a bit different. So the idea is that we have various returns for BB and various returns for SM, right? We are given the returns already. So how do we calculate first of all, we calculate the mean returns for BB. So we calculate the returns per stock, right? BB and SM. So per stock, we use the arithmetic mean to calculate the returns as given by here, right? So recall method one, we straight away multiply into the portfolio, right? So we calculate portfolio mean, portfolio A mean, portfolio B mean, etc. But now in method two, we calculate the mean per stock first. Having calculated the mean per stock, we know the portfolio percentages, right? For portfolio A, there is 25% of BB, 75% of SM. We just multiply the means inside it by the percentage, and we get the same answer, exactly the same answer. But can you see the concept is slightly different already, right? We are calculating mean per stock, multiplying it into the portfolio. Now, the standard deviation is the part that would make a difference now. Okay, so what's happening here? So we have the returns per stock. So now we use the standard deviation formula in Excel to calculate the standard deviation per stock. So this one stock, for BB, what's the standard deviation? For SM, what's the standard deviation of this one stock? So this is a very important formula. It actually is a bit small. I should make it bigger, but I put 3 stars here. So this is the part of the formula that is important. So in finance, the portfolio variance formula is given by W, means the weight of that asset, square, multiplied by sigma square, which is the variance of the asset, plus W2 square, which is the weight of the second asset, sigma 2 square, which is the variance of the second asset. Now, this part here is where your diversification is happening. Plus 2 times the first weight of the asset times second weight of the asset times covariance. So this is the covariance. There is a small explanation here. What is covariance? So the covariance, this is where diversification is happening. So the covariance is the joint, so the meaning of it is the joint variation of the two assets. So when you compare the standard deviation of two assets, what is the joint variation? So you join them together, right? That's why it's covariance 1, 2, means covariance of the two assets. Now, the question, I think the follow-up question is, what is covariance, right? How do you even calculate covariance? So given Excel, it's actually super easy to do it. We can just use the covariance formula here. And we just put the value as this chunk here, right? Where the value is the security of the, so you find the joint returns of the 5 years, or in the 5 years. So this is the covariance. Now, having calculated the covariance as required by the formula for portfolio variance, let me just see what's the covariance with 3, 6. So we can multiply the covariance. This is the covariance that we calculated, and we just multiply all the values here per the formula given to calculate the portfolio variance. And if you compare both answers, they are totally the same. So what's happening here? Can you see that the covariance, this portion here, is the one that is going to provide the diversification benefits. So looking at this value here, if this value is smaller, is better, right? Because it will reduce this factor because you plus a smaller value means that the variance is smaller, the SD is smaller. Everyone can understand this? The covariance, if this covariance factor is small, it's very good, or small, or even negative. This is a very important point. Everyone understand? If it's small or negative, it's very good, right? Because it reduces your standard deviation. And when your standard deviation decrease, your risk, your total risk decrease, right? And your covariance, actually there's another formula. Your covariance is equal to correlation times sigma x, sigma y. Sigma is standard deviation of the first asset times the standard deviation of the second asset. So your covariance equals, if you do your secondary school X-Men, where your covariance equals to correlation times this. So how do you calculate correlation? You just use the correlation formula in Excel as well. So anyone needs me to repeat this part on covariance, because this is an important concept here. Or is everyone okay? Any questions? Okay, so uh, as a small broken record, I'll just repeat to make sure we all understand that this factor here, the covariance, is providing diversification. And we want this value here that we have calculated to be as small as possible, or even negative is even better. Why? It's because it will reduce the variance value. And when you reduce the variance, your total risk decrease. Okay? So this is an important concept. So now, having done the calculation in method 1 and method 2, we can see that method 1 is really statistics, right? We can't really see where the diversification is happening. But method 2 is very clear how the diversification is happening and where we derive the reduced risk in diversification, which is given by the covariance factor. So yeah. So I hope that part that I repeat about covariance makes sense to you. Yeah. Or which other part do you need to repeat? Feel free to put in a group chat and I can repeat that part. Yes, it makes sense. Okay, perfect. Thank you. That's great. So I hope we can see that the covariance here is the one that's reducing your risk. So if it's small like this or negative, is very good. So you want a negative covariance or small covariance, right? And what is covariance? Remember, covariance is the joint movement or fluctuation in the returns, right? The joint. Remember, for standard deviation, it's just one stock. The movement of returns one stock, but covariance is the joint movement, right? And covariance, in case some questions they don't give you covariance, they give you this thing called correlation. We have this formula here which connects correlation to covariance, where correlation equals to covariance divided by standard deviation of the two assets as seen here. So based on the question, sometimes they might be a bit tricky. They say the correlation of the stock is this. Then you're like, oh, what's correlation? How do I calculate it? How do I convert it to covariance? So this is how you calculate. You use this formula, use your secondary school X-Men method to calculate, and then you can calculate covariance, you plug it into here, right? Because if you are given, so the idea is that if you are given the returns, you can use Excel to use the covariance formula, .s, correlation formula. You can use all those, right? But sometimes the question want to force you such that you cannot use Excel. So it give you the value already. Say covariance of, or let's say the correlation of the stock is 0.45. So if they say that there's no way for you to use Excel to calculate, right? So then we need to use this formula here. Okay, so we will do asset. No, okay. So for two asset, it means that any two assets. So it can be the same thing. It can be two different stocks as well. So maybe stock A, stock B, or it can be stock A, bond A, right? So it can be the same type of assets as well. Now, for the purpose of this course, we are only doing two asset. There is as you, of course, we know that most people have portfolios that is more than two assets, right? Maybe three assets, four assets, sometimes even not enough three assets. It must be 100 assets, right? 100 assets meaning 100 different stocks, or maybe 100 stocks, 50 bonds, 50 type of bonds, right? So for the purpose of this course, we are only doing two assets. The reason being is that as we add more and more assets, the calculation explodes. Explodes meaning that it's very complicated, right? It's possible, but it get very, very complicated. So much so that we cannot even, it might be tough to use Excel. You can when you set up like a so-called a model to do the calculations for you. So for the purpose of this course, we are only doing two assets. So it means can be two stocks, two bonds, one stock, one bond. That's about it. Okay. So we have done the calculations for portfolio. We will use the calculations again in a little bit, but let's just do a small little digression, right? So the idea is that in order for the market to be efficient, you need some inefficiency. And this is the explanation why, right? So I repeat again, in order for the market to be efficient, you need some inefficiency in the market. And the reason is explained here. The idea is that there must be some surprise component, right? And whenever there's surprise component, if it's a surprise, it means the market is inefficient, right? Because if the market is super efficient, remember their strong form efficiency, it should include all public and private information, right? There is no surprise at all. However, you need some inefficiency, and so there's some surprise. And when you have this surprise, what's happening? You have a surprise, and the market will quickly process and integrate the information of the surprise into your stock price. Okay, when it incorporates your surprise information, the faster it incorporates your surprise information, the more efficient the market, right? The faster it does it, the more efficient. And so in order for the market to be efficient, you need the surprise, right? So it becomes a cycle. You need some inefficiency so that you have surprise information, and allows the market to quickly incorporate the surprise to create more efficiency. This is what it's trying to explain. Now, now we can dissect total returns. Remember, your total returns is your capital gain plus your price, your capital gain plus your dividends. So now we can dissect returns into expected and unexpected. So in general, on average, your unexpected component is usually zero. And this is based on your efficient market hypothesis, right? Because on average, there is no excess return, there is no alpha return or abnormal return, right? So the unexpected abnormal return is usually zero. The expected return, and so there's this small part here. The surprise information is the one that gives you your unexpected return. Now, your unexpected return, you can break them down into two components here, systematic component and unsystematic component. Okay, so again, repeat you have your total returns, which is equals to expected plus unexpected. Your unexpected component is broken down into systematic and unsystematic. And we will see what it means here, right? So hold that thought if you're like, oh, what's systematic, what's unsystematic? So let's think about it, right? So we have an explanation here. So your systematic returns, or in a sense, because risk and return are the same, right? Same meaning the amount of systematic risk you take is the amount of systematic returns you get. So what is this systematic returns? It is relating to systematic risk. And your systematic risks are basically things like we call it undiversifiable risk. So risk or market risk. So basically risk, right, that affects everybody in the market. So things like inflation, GDP change, interest rate change. So these are systematically affecting everybody. That's the idea of systematic. It means that you affect everybody, all the asset classes. So this systematic risk. And this risk cannot be diversified away, meaning it cannot be reduced, right? It is always there. And this risk is called beta. Okay, just put that dot. What is beta? Just know that's called beta. We'll discuss and calculate beta in a bit, right? But just put that thought in your mind that this kind of risk is called beta. Okay, now your unsystematic risk, which relates to your unsystematic returns, okay, is called your diversifiable risk. So this risk can be diversified away. And recall your diversification is done by your covariance 1, 2, right? That's why I kind of like the method 2, where you actually use the finance method to able to derive the covariance. And your diversifiable risk is based on your covariance 1, 2. 1, 2 meaning asset 1, asset 2. AFX, limited noun asset, it can be eliminated and is eliminated using your covariance. And so what are these risks, right? What's the unsystematic risk? So unsystematic risks are usually called unique risk, asset-specific risk. So for example, it can be a labor strike in the healthcare industry, right? Does it affect manufacturing industry? No, it does not. Or maybe it can be a parts shortage in the manufacturing of cars, but does it affect your grocery industry? It doesn't, right? So can you see that it is very specific to maybe the sector, maybe even the company, but it is not systematically affecting everybody, like what we talk about in the GDP change, interest rate change, which affects everybody. I'll pause for a short while. Any questions regarding the understanding of the systematic, unsystematic is very important, because we're going to dive deeper as we go along into the meaning of this risk and how we calculate this risk. Okay, so maybe there's no questions at the moment. As usual, if you, as the week progresses, if you re-watch the lecture, if you have any questions, drop me an email. We can actually try to help you understand various concepts better if you need some help. So moving on to the principal diversification, as we talked about it earlier, the covariance 1, 2. The idea is that diversification helps you reduce your risk, but it does not reduce your return. So that's the good thing, right? And we proved that in the calculation using method 2, right? We see that the covariance factor help you reduce the risk, but it does not affect the mean returns at all, right? If you notice, it does not affect the mean at all. The mean is still there, it's the same, but it's just the covariance, if it's negative or small, it kind of reduces your variance and hence your standard deviation, right? And therefore, your standard deviation or your total risk level is lower. So it reduces variability, as we can see in the, 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 in And the thing is that diversification, as we mentioned here, only affects your unsystematic risk component. So your systematic risk cannot be diversified away. So the minimum level of risk that cannot be diversified is your systematic risk, and this is given by beta, right? And again, hold that thought about beta because we'll talk about beta in a bit, right? But this is called beta. Beta, either beta risk, systematic risk, undiversifiable risk. There are many names to it, right? But we can call it beta risk as well. Okay, so as we kind of already proved in method two, if the correlation is one, right? Or the covariance is one. Because remember, correlation is equals to covariance divided by SD times SD, right? SD of one and two, covariance one, two, and correlation one, two, right? Because everything is based on the formula. So the thing is, if the correlation is one, there's no risk reduction, right? If it's one, that means your covariance is one or so. So there's no risk diversification. Remember earlier I said, if your covariance is smaller or negative, there is some diversification happening. So in the same sense, your covariance, because since you're equating covariance and correlation in this form, whatever that's affecting your correlation affects your covariance, right? So if it's negative or less than one, you have some diversification that's happening, and you are able to diversify your unsystematic risk away. And only unsystematic risk, only, right? Unsystematic risk is being diversified away. Your systematic risk given by beta is that it cannot be diversified away. So, question for all of you. Do you want a positive correlation or negative correlation in your portfolio? Which one's better? Negative. I hope everyone can see negative. Negative, that's right. Why? Negative? Because if you have negative, you have risk diversification, right? So you want a negative correlation. So you have risk diversification given by the proof was in method two. We did the so-called the proof where it reduces your SD or your variance, right? So you are negative. Positive is bad because sorry, one is bad because there is no risk reduction. If it's positive, if it's less than one, it's still okay, right? Sometimes you cannot get negative, you get positive but less than one, but negative is better. So between negative and positive, you want negative. So there's risk diversification. So portfolio conclusion, the more stocks you add, the better it is because you diversify away the risk, your unsystematic risk. Okay. Remember, it's only unsystematic risk. And so this is what we see here. As you add, so this is the number of stocks in the portfolio. This is your standard deviation, which equals to total risk, right? Your standard deviation is the total risk. And as we see here, your diversifiable risk decrease as you add more and more assets. Your non-diversifiable risk given by beta remains unchanged. And Again, I repeat, diversification only happens when your correlation is negative or less than one, right? So negative is better than less than one because you remove more risk. So total risk is given by SD, standard deviation. Total risk equals to systematic plus unsystematic. So standard deviation gives total risk. So this is important. So whenever they ask you what is the total risk is standard deviation. Now, systematic risk is given by beta. Unsystematic risk is given, can be diversified away using the correlation um, of your assets in the portfolio. So for well-diversified portfolio, unsystematic risk is very small. So for the systematic risk principle, the idea is that you remember just at the start of today's lecture, we talked about risk and rewards. You are being rewarded by taking more risk. So now having understand the idea of systematic and unsystematic risk, we can refine this understanding a bit more, right? So we are only rewarded by taking on systematic risk. Okay? Rewarded by bearing risk, but it must be systematic risk. We will not be rewarded by taking on unsystematic risk, which means that whenever we invest, we need to invest in a diversified portfolio. So I repeat again, this is important. It's a key concept is that whenever we take on risk, we need to take on systematic risk only because we are being rewarded by taking on systematic risk. If we are taking on unsystematic risk, we will not be rewarded, right? We will not gain anything. Okay, I think now is a good time we can take a break, our second break. We'll come back in around 6 to 7 minutes, meaning around 9, 12, if that's okay. When we're back, we'll try to finish off the lecture. And if you do have any questions, put them in the group chat. We'll come back in 7 minutes. All right, welcome back again. So we'll move on to our last part of today's lecture. Let's think about this thing called beta, right? And beta is, as I mentioned earlier, is systematic risk. And I keep on saying, okay, think about it as beta and put this idea of beta aside, right? But now let's tackle this thing called beta. Okay, so beta measures systematic risk, and we know that beta risk or systematic risk cannot be diversified away, right? So even if you hold a well-diversified portfolio, your beta risk will always be there, right? So you'll still be there. Now, beta, this is an important point. I'm going to put a star here in terms of understanding beta, right? So beta is the stock's volatility relative to the market. So beta is always compared to the market. Okay, and you're comparing the volatility of that stock with the market volatility. This is important. Why? Because as you progress in even this course or even other courses, right? If you are a finance major, for some of you that decide to do the finance major route, you keep on hearing beta, and beta becomes like a concept, like it's like the number that appears out of nowhere. However, I want to really emphasize to you that beta is not a number that appears out of nowhere, because you can get beta from Yahoo Finance, you can get it from everywhere, and everybody's beta is different. So for example, if you want to look at Amazon, Yahoo Finance will say this beta. If you go Bloomberg will say this beta. You go to another Refinitiv, so all the different platforms have all the different beta for the same stock. So the idea is that I want to emphasize that beta is not a number that just appears out of nowhere. It is basically the measure of the stock's volatility relative to the market's volatility. So the reason why we see beta number that is differing, sometimes can be quite a lot, is because of the way it's been calculated. It's a measure of relative volatility. So sometimes certain platform measure beta, the market volatility different, right? So maybe that stock volatility is same, but the market volatility might be different, right? Some people say S&P 500 is not the market volatility. It must be S&P 500 plus NASDAQ plus maybe something Nikko, like basically all the different kinds of index, right? So that's why you have different numbers for beta. But beta is always relative to the market. So what does this mean? A beta of 1 equals to average risk, right? Means that your relative to the market, you are 1. So beta is like a ratio, like it's like a ratio, like 1:1, right? So the market, the volatility of the stock is equals to the volatility of the market. So average risk. Beta of more than 1 means that it's riskier than the market, more systematic risk than the market, right? Now, if it's less than 1, less risky. And what's important is that the beta of the market is 1, and the beta of a T-bill is 0. Anyone knows why? Why is the beta 0 for T-bill? Perfect, you're right. 0 risk. So there's 0 risk means that beta is 0. So these two beta I'm going to put a star here, right? These are your fundamental beta that will never change. So market is always 1, T-bill, 0 risk is always 0. Okay, so these are fundamental betas that you need to know. Okay, having the idea, again, I repeat, beta is the measure of relative volatility to the market, or volatility relative to the market, right? So that's the measure of beta. This is important. Okay, so you can see there's the various beta. I'm not too concerned. Now, in terms of weighted average of beta, you can actually combine the beta quite easily. You just multiply by the weight times the beta of the asset. So that's how you measure the portfolio beta. It's just the weight of each betas. Okay. So we have this question here. So it's a good way to test understanding. Which asset has more total risk? Anyone can just type the answer, or you want to unmute yourself, it's fine too. At total risk level, which asset has more total risk? So asset K or asset K or asset C? Okay, we have one C. Anyone else want to give a try? We have one K, C cause higher beta. Okay, so we have a mix of answers. Some they have two C's and one K now. Now, let's try to see what is okay. One more K. So total risk. Remember what measures total risk? What is the variable? Is it beta or is it SD? Okay, we have more K. SD. Correct. SD. So SD measures total risk. So which SD is higher? We can see is K, right? So this security has more risk. K. So the answer is K. So which security has more systematic risk? Okay, I see the answer for systematic. Systematic is beta, so it's C. You're right. So beta measures systematic risk. Okay, so this answer is C. Now, which security should have higher expected return? Okay, this is a bit tricky, yeah. So which one? Okay, we have one K. What? Anyone else want to give it a try? Higher expected return. Okay, everyone says K. Now, this is a trick question. The answer is C. Remember why? Remember? So remember the concept of beta? So I remember I said that beta measures systematic risk and investors are rewarded by taking on risk that they cannot diversify away, right? Meaning beta risk cannot be diversified away. And yes, that's right. They should not take unnecessary risk. So if you're taking a standard deviation of, which measures total risk of 30%, you are not going to be rewarded. You're only going to be rewarded by taking on risk that is necessary, which equals to systematic risk only. So this is important. So you're only being rewarded by taking on systematic risk, which is beta, and not by taking on more risk under total uh, under standard deviation. Okay, so to emphasize this point again, I want to highlight that you are only rewarded by taking on systematic risk that is necessary. And this necessary systematic risk is measured by beta. Okay, you are not rewarded by taking on unsystematic risk measured by, okay, it's not measured by anything. There is a measure, but we're not going to learn that. But we're not going to be rewarded by taking on unsystematic risk, which gives you a higher total risk amount measured by standard deviation. Okay, so we are only rewarded by taking on beta risk. Okay, so we have kind of understand the idea of risk premium. So we're going to pull back this understanding. Remember, in the start of the lecture, we kind of define what is the risk premium by saying what is the return minus the risk-free, and then remember we did the stocks, bonds, and then we do treasury. So we are going to pull back this example again. And the idea is that the higher the beta, the higher the risk premium. And recall that we are being rewarded by taking on beta. So higher risk premium, higher RP, risk premium, equals to higher returns, right? Which means, which equals to higher beta. Okay. So we can actually define a relationship between beta and the risk. The beta risk and the returns. Okay, so this graph looks a bit scary. Let me explain to you. So don't worry, we'll dissect the information bit by bit, okay, for you to understand. So let's plot a graph of beta, asset beta, and expected return. Okay. Recall I mentioned that there are two betas that are very important that you must know by heart. That is the risk-free beta, where it is given by 0, correct? And the market beta, which is given by 1. So I plot these 2 points on the graph first. Can you see here? Risk-free, what's the beta? 0, right? And I have this return for risk-free. Remember, your risk-free is like your treasury bill. Your treasury bill has a return as well. Let's say 3.6%. Now, your market beta is given by 1. Remember, I said it's a very important beta to memorize. And maybe this is like 5%, right? So maybe this is 3. Your risk-free is 3%. So we have two percentages that are important. Your risk-free and your market beta. Now, having said that, what is the gradient of the line? Anyone can define what's the gradient of the line here? So let's let's not talk about finance now. Let's think about your secondary school when we do graphing. So what's the formula for gradient of the line? So gradient of a straight line equals to y1 minus y2, perfect. Divide x1 minus x2. So let's put in the values here, okay? Gradient equals to y1. So what's y1? ERM minus y2, which is RF. Okay, everyone get that? Divided by beta M divided by beta RF, right? And this, remember, M is 1, so, and RF, so this one equals to 1, right? Because 1 minus 0. So equals to ERM minus RF, right? So that's the gradient of a line. So just now I also saw someone say y equal mx plus c. That's the next thing I'm going to talk about. Thanks for that. And that's the equation of a line. So gradient is given by this already, ERM minus RF, right? This is the gradient. So having seen, I didn't know you can delete the comments, but that's pretty cool. Okay, so y equal mx plus c. So gradient of a line equal y equals to mx plus c. So what I want to try to encourage you to do is, let's try to think, how do I find the equation of this line? Okay, so which is y is given by what? Expected return, ERI, right? Y. What's M? So M is given by this, right? ERM minus RF times X, right? What's X? X is BI, right? That's given by here. Plus, what is C? C is the y-intercept, right? What's the line that's cutting the x-axis? Y-axis, which is given by, this is a different color here, RF. Can everyone understand this equation of line? How I get this equation of line? This is important. This is very important because we're going to use this equation of line for many calculations. Anyone needs me to repeat, or which part you do not understand? So this graph is really more for understanding. I want to highlight to you that in the exam, they'll never ask you plot a graph like this, derive for me equation of line. No, it's really for understanding, because what we are going to use is to use the equation of the line, right? As given here, equation of line. We're going to use this equation. So you'll never be asked to prove this. And so this equation of line is actually called this thing called CAPM. Okay, just put in mind, it's called CAPM, capital pricing model. And the thing is, given that we are using these two very important point, 0 and 1, we are actually assuming that whatever asset portfolio that we are going to calculate using this equation of line, it must fall on this line with the given gradient as such, right? The gradient as we calculated here, the gradient here. So it means that given that we're using a market beta means that it is fully diversified, right? It means that you need to, the underlying assumption is that it is fully diversified away and only has systematic risk. So all unsystematic risk is diversified away. So this is important because, sometimes assessment, they like to have small questions, what are some disadvantages of using, in this case, the CAPM model, right? Capital asset pricing model. Then you need to talk about this. It has assumption that is based on a fully diversified portfolio with only systematic risk. However, maybe let's say in that question, we do not know whether it's fully diversified, right? You will assume that it's fully diversified. So these kind of things, sometimes they like to, have this kind of short answer questions, and you need to be able to understand the concept before you can explain. So I hope everyone understand, right? In this case, because you are using the market beta of 1, you are assuming a fully diversified portfolio. And this line is called the security market line, SML line. Okay, so having done the calculation for gradient and therefore done the equation of line, what can I do now? So we have this thing called the risk and reward ratio. So what does this risk and reward mean? Okay, so I'm just going back to this line. I'm just going to get a different color. So this is risk, right? Beta is risk. Expected return is reward. So do you notice that the gradient here, the steeper the gradient, the higher your risk and reward, right? Obviously for a given, let's say, right? Let's say for a given risk level given by beta here, can you see that the steeper gradient will give you more returns, right? Can you see the gradient give you more returns? The steeper it is, the more returns you get. Then, like here, you get more returns. Here, you get lesser returns. So with this in mind, your gradient, this formula here, is your risk and reward ratio. Risk and reward meaning for a given risk, what's your reward in terms of expected returns? Okay, so is this right? However, why is there divided by B beta J is because in your example here, in this example, we are using market beta, right? BM. Oops, now it's acting up again. Okay, so you can see that's BM. Because now I don't know why it's like this. But in a generic case, it might not be market beta, right? So market beta BM is 0. Sorry, it's not 0. It's 1, right? But in this case, for any generic asset, it will be beta J, which is equal to the slope of the line. And I proved to you, right? The steeper your gradient, the more reward you get for a given risk level. At equilibrium, all ratios should have the same gradient. when ER is plotted against this, we give a straight line as we've seen earlier. So this ratio is important. It's called the trainer ratio or reward to risk ratio. So sometimes questions you can ask, oh, can you calculate what is the risk to reward ratio? And the risk to reward ratio, in your mind, you should think, oh, okay, it is the gradient of this SML line, right? Is the gradient. And the steeper the gradient, the higher the risk to reward, right? So in that sense, you want a larger, a steeper gradient. Whenever you calculate, if you compare, so now let's think about it. If you compare the risk to reward ratio, the higher the value, the better, right? Because the gradient is steeper. And as we proved earlier, the steeper the gradient for a given risk, there's more rewards. Any questions regarding this? So this is a very fundamental concept that you really need to understand so that you can grasp the concept of what's beta, what is systematic risk, and as we progress. I'll pause here. Any questions? Okay. So at market equilibrium, all your assets must fall on the one line that we have. What's happening here? Okay, let's try see whether it works. Okay, you have your slide, so you can have a look at that. Now, and it's given by the risk to reward ratio, as we talked about. So it's just a repeat. So again, this is another repeat. The SML line represents market equilibrium. And what does market equilibrium bring? Means that unsystematic risk is zero or is fully diversified away. Okay, this is important. Market equilibrium means that unsystematic risk is all gone. So we are only concerned about systematic risk. All security must fall exactly on the SML line. SML line gives you the reward to risk ratio. And for market beta, this gives you the risk premium, right? So ERM minus RF gives you the market risk premium, and it's always, since the beta of the market is 1. So it's what we have proved earlier. Okay. So this will force you to kind of understand the SML line a bit more. So let's have a look and try to understand this. A change in characteristics of individual investments means a change in beta, right? So that means we are moving. So this is the line. It means the movement. So when there's a change in characteristics, the beta here, so it means that we are moving from, let's say, here to here, right? So that means the beta increase, let's say. So there's a movement along the line, right? So you're moving along the line. Now, a change in attitude of the investor towards risk would affect the risk premium, meaning what? We are talking about the slope, right? Change attitude means that you're talking about the slope of the line. So it becomes steeper like this, let's say. So for a given risk, you have, let's say, more rewards, right? So the slope increase. So it's a change in slope of the line. Now, if it's a change in market conditions, so the whole market change. Now, this would cause a parallel shift in the line. So initially a line might be like this, it becomes like this, goes up, parallel shift. Any questions for this? So this is just some characteristics, right? So we can really understand the SML line a little more and what does it really mean to you. So when there's, lastly, I want to mention when there's a parallel shift, right? It makes sense, right? Because the risk-free, let's say if the conditions are worse, so maybe the risk-free rate increase, right? Your risk-free RF increase. So that's why there's a shift. And your gradient also increase. No, sorry, your gradient don't increase, but your risk-free increase, right? So that's why there's a shift. Okay, so with the formulation of your CAP-M model, which is actually equals to your y equals to mx plus c, we formulated this, right? We have proven this, that this is the equation of a line, of that SML line, right? And so using this equation of a line, we can actually calculate what is the ERJ. What's ERJ? Expected return of any asset if we have the beta of the asset given by B beta J, and we have this is called the risk premium, right? Risk premium, which is here. And this is market returns. Okay, so at this point, right, I want to emphasize this. Please read the question carefully. So usually, I think they always like to trick you in the sense of sometimes they give you return on market, RM. Sometimes they give you risk premium. So please read the question carefully. If they give you market returns, you still have to minus RF as given by this equation here, right? To calculate risk premium. Now, if the question gives you risk premium already, it's like that. So risk premium times beta. So you do not need to less off the returns, risk-free returns. Everyone understand this? This is very important because if you do wrongly, it will really affect your part 2, part B, C, D, because usually calculating the expected returns for the asset is the first step. So read the question carefully. Are they giving you market returns or are they giving you market risk premium? All right, market risk premium is this. Market returns is this. So if you give market returns, you do need to less off the risk-free rate as given here. If they give you market risk premium, you will already have that incorporated. So you just solve it accordingly. Sometimes they will be very tricky. They will say the S&P 500 returns. So you need to know it's market returns. And as I mentioned earlier, sometimes they'll say the T-bill or T-bond return is 5%. This equals to risk-free. So they like to use different terminologies to try to make it difficult for you. But you have to be aware what it means. So this is just an important part. If you know the beta of the asset, you can determine the expected returns. And remember, CAPM only compensates the investor on systematic risk. I don't know, there's like a bug on my iPad. Okay, but you can see on your slides. So recall, again, I repeat, if you're using an SML line, all your unsystematic risk is being diversified away. And what's left, it's only your beta risk and systematic risk. So this is an underlying assumption that you are actually holding a well-diversified portfolio. Okay, this is an underlying assumption. Now, let's look at this. Okay, so if we are given the beta here, and we are given this thing, right? We can calculate what is the expected return using the CAPM model given by this, right? We have risk-free, and this is market returns. So market returns means that we need to take 12 minus 7.5 to get the risk premium, RP. So we have calculated, then using the CAPM, we calculate expected returns. This is CAPM, using a CAPM model. Now, if you expect to get 14% in stock A, but your required return is only 13.4%, it means that it's undervalued, right? Because you are likely to get more. So that means this stock is undervalued. Now, if you expect to get 10%, but you require 11.1%, means this stock is overvalued. Okay, this is just a repeat. Let's not. Okay, so I believe, let's see. Give me a moment. Okay. So we have a small example here. So what is the risk and reward ratio at equilibrium, given that you have a beta of this, risk-free of this, and market return of this? So we can remember this is your gradient, right? Given by the return on the market, 13 minus 5% risk-free divided by at equilibrium means market return, so given by 1. Because remember this, the beta of the market is 1, right? Remember the two betas that I say you must remember. Beta of risk-free is 0, beta market is 1. Now, what's the expected return on the asset? Expected return using the CAPM model, it is risk-free RF plus risk premium, which is market returns, 13, right? Market returns minus risk-free times beta, right? Which is what is done here. Okay, so you have this quick example here. If you have $1,000 invested in 3 stocks, the amount invested for A and B are the same, but C is different. Okay, so how much you invest in C, given the following returns and required return of the market of 3.5%. So this example, let's try to understand this, is you first let the weight of the asset be W. A, so A and B is the same, right? Okay, this working is, I like to do it myself. Let's just see. So let this be W and this will be W as well, right? So then this will be 1 minus 2W, right? In terms of weight. Now, having calculated this, we can formulate where W, the weight of A times 1% plus W, the weight of B times 2% plus 1 minus 2W times the weight of 4% must be equals to 3.5%. Okay, so you calculate for W. Once we get the weight of W, then you can find the weight of C. So solutions are here. Basically, they are doing what I told you here. And we calculate the weight, we solve and get weight of 10%. So the amount of stocks that you should invest in C is 1 minus 2W, meaning 1 minus 0.1 times 2 means 0.8, which is, and you multiply by 0.8 times 1,000 equals 800, as given here. Okay, so I'll pause here. Actually, that's all we have for today's lecture. Any questions, any comments so far, or any queries? concerns. So that's all we have for today. So as you think about any questions you have, I want to highlight again, I encourage you to practice the self-review questions. Answers are provided for each question. If you do have any issues with the answers, do not hesitate to reach out to me. Happy to answer or clarify any doubts you have. Yes, I think there's a formula sheet um, in the lecture site, the L01 site. Um, I believe, if not wrong, if they haven't changed the final exam is usually open book. If they have not changed it, it's open book as for last few semesters. I'm not sure whether they have changed it, so look out for the email from the school. However, do note that if it's regardless open book or closed book, I believe there is a formula sheet. Okay, sure. Quiz this one? Okay, this one here. Okay. Any other questions? Yes. So for the TMA, I will be going through the TMA after, usually I mark quite fast. Usually I mark within a couple of days. So if everything goes well, everyone submits, all the other other classes also submit the TMA and we can release the result. Usually I'll go through a TMA in the class after the submission date, right? In terms of going through like the questions now, unfortunately we can't do that. We can't because it's assignment at the end of the day, we can't go through. However, if you need some clarification reading a specific question, simply drop me an email. I see whether I'll try my best to answer. But for the fairness of all classes, unfortunately, like as instructor, we're not able to go through the TNA in terms of going through the questions. But if you do have any specific questions that regarding the TMA, just drop me an email. If it's a so-called fair question that does not disadvantage your other classmates, I will happy to answer them. T object. Well, unfortunately, we can't give any tips on the TNA. Wait, I think we are done with the recording. So let me just pause it. Stop recording. Okay.